Hello, and thank you for joining us today for tax-exempt organizations 457B and 457F plans. My name is Lindsay Knopick, and I am the marketing manager for Multnomah Group. And our presenter today is Brian Montanez, one of the principals of Multnomah Group. Before we get going, just a quick reminder, everyone is on mute to make sure that we have good sound quality for everybody. We are recording this and we will share the materials after the presentation. If you have any questions, don't be shy. Please fill out the Q&A section of Zoom. Brian loves to answer questions, and especially on a topic of this nature, which we know brings a lot of different questions. So, and we will answer them as we can throughout the presentation. With that, take it away, Brian.
All right. Thank you, Lindsay. So why are we here? Why is this such an important topic? So I decided to create this presentation because of some historic work on the IRS's side. So back in 2013, they began a compliance check project on 457B plans. And they found numerous and continued errors. And those errors are really a function of participants, or I should say plan administrators, not truly understanding the rules. So what was the IRS looking for and what did they find? So as a result of the IRS audits on 457B plans have increased in the past few years because they found a number of issues that persisted. And here's what they found. So first concern was whether there had been a timely adoption of the original plan document and amendments required by law changes. Unfortunately, what I see is 457Bs of tax exempt, and let me make this point, these are not for governmental entities. That's a different IRS tax code. These are for nonprofit organizations. So the 457 plans, unfortunately, seem to take a back seat in the administration of these plans, and people tend to forget about them. So I regularly see that the 457B plan, the document itself, is not maintained. They were looking to see whether the group of eligible employees had been properly limited to a select group of management or highly compensated as required. So there's no hard and fast rule, but the IRS has given guidance that you should keep it to less than 10% of full-time eligible employees. So keep it below 10%, keep it to a highly compensated group or a management group. It is not necessarily something you offer to an entire population. And whether there's been compliance with the annual contribution limits and special catch-up rules. And we're going to go through that further and deeper. But these rules are different. The simple problem is the $19,500 limit for this year includes employee and employer money. It's not like a 401k or 403b where you get $19,500 of salary deferral plus employer money. Nope, that $19,500 is both employee and employer. They're looking to see whether there's been compliance with the rules governing the timing and manner of distributions. We're going to cover that in depth today. One of the bigger problems that most administrators don't understand is that this is not a type of plan that you can defer indefinitely. Once the participant's employment is terminated, that does trigger specific distribution requirements, depending on whether it's a 457B or a 457F. And whether FICA and income taxes have been properly and timely withheld and paid and reported. We're going to cover that. One plan is subject to FICA and FUTA, one plan is not upon contribution, and then upon distribution, the rules are different. We'll cover that. And whether the top hat notice required by the DOL was properly filed. So 457B plans are subject to the Department of Labor and ERISA requirements. However, there is an exemption available. But unfortunately, I'd say a third or more clients never filed that exemption. So they would have been subject to ERISA. So the talking points are designed around my experiences in working with nonprofit organizations and what the IRS has said they have seen problems with. So we'll talk about eligible employers, why the plan sponsors offer these plans, the application of the IRS and ERISA, as well as that exemption. Plan eligibility, security of assets and funding rules, contribution limits, vesting, distribution rules, taxation, and who's going to file that tax filing, as well as available investment types. So eligible employer. So again, these are not for governmental entities. These are for nonprofit organizations. And these non-qualified deferred compensation plans are employer-sponsored plans of 501c3 or non-governmental taxed organizations, and it's limited to a select group of employees. 457B for governmental entities are a different tax code. Generally, those who participate in a 457B plan to defer a portion of their annual compensation, but employers may also contribute, and that's where we get into the challenge with the limits. And generally, those who participate in a 457F plan have the employer contribute, but eligible participant can defer up to 100% of their compensation, but that's a risky proposition, and I'll cover why it's a risky proposition a little bit later. 457B are defined contribution plans, but a 457F can be a defined contribution or defined benefit plan, and we'll talk about how that can affect some of the limits. So why do employers offer deferred comp plans? So this is a study done back in 2016 by Principal, and they're one of the largest administrators of 457 plans in the country. So why offer a plan? Well, it helps participants save for retirement beyond qualified plan limits. What does that mean? Well, first off, think about it. It's an executive comp plan, a deferred comp. It's limited to highly compensated or management people, right? Often those folks will make more than what the IRS considers compensation for a qualified plan. For example, let's say it's for a CEO or a president, and that person makes $500,000 a year. And their employer retirement plan, the 403B or 401k, has a 5% contribution. They don't get 5% of 500,000. They only get 5% of what the IRS limits the compensation to be, which this year is 290,000. So the difference between 290,000 and the 500,000 that they earn, that 210,000, they're not getting the 5% contribution on that. So functionally, they're not getting the full employer contribution to their retirement plan. These plans allow you to make up that difference. Provide a competitive benefit package when recruiting employees. My colleague Brian just did this recently with a hospital client of his. They were having trouble finding a CFO. So the CEO and Brian got together and they decided to offer a 457B to the CFO to recruit a more of a population to evaluate and hire a CFO, which it did work. The 457B plan wound up being the difference between the person saying no and saying yes. And similarly, to retain key employees, the 457F can be golden handcuffs. But also having a competitive benefit package that allows participants to receive their full retirement package, again, because the IRS limits on compensation, that is a significant difference between potentially having a valued employee leave employment and stay. And that's the ability to get their full retirement benefit. So application of the IRS, ERISA, and an ERISA exemption. So first off, all deferred compensation arrangements of nonprofit organizations must comply with Section 457 of the IRC. 457 plans are non-qualified plans, therefore not subject to non-discrimination testing. So if you run an ERISA plan, which I think most of you do, you have non-discrimination testing at the end of the year to make sure that the highly compensated aren't getting significantly more benefit than the non-highlies. Those rules don't exist here. In fact, that's the nature of these plans, is to discriminate and benefit a select group of highly compensated employees. And 457 plans are not subject to ERISA. Well, they actually are, but you can file a top hat exemption letter. It's a one-page document that lets the IRS know that you are, or lets the Department of Labor know that you have a 457. Consider it a birth announcement. That's it. There's no follow-up to it. They're not going to send you any letter acknowledging that you sent the letter. But if you don't file the top hat exemption, you are subject to all those ERISA disclosure, notice, and reporting rules. Here on my first bullet point, you can see search the askebsa.dol website there. And if you use your organization's EIN, you can find out if you filed the top hat exemption letter. If you're not listed on that database, I would suggest contacting an attorney or a TPA and filing the top hat exemption letter. Again, without that letter, you're subject to all the ERISA disclosure, notice, and reporting rules, and those penalties for not meeting those rules can be substantial. If you did not file that top hat timely, the DOL does have a delinquent filer voluntary compliance program. It's an amnesty program, and they will exempt you from any penalties if you go to them. But if they come to you, they're going to hit you hard with penalties from the DOL. So please, if you're an administrator, take a look and see if you filed the top hat exemption letter. 457Bs must limit to a select group of people to maintain tax favored status. So that first question that we had today from that one person, no, we don't make it available to a large population. And I'm going to get to this a little bit later, but generally speaking, 10% or less of your full-time employees. I have seen people that have made it available to more than that, and that can be a problem if the IRS comes knocking. 457F plans, assets and compensation must be subject to substantial risk of forfeiture. What does that mean? Well, here's the IRS's definition. Substantial risk of forfeiture. A substantial risk of forfeiture exists where rights in the property that are transferred are conditioned directly or indirectly upon the future performance or refraining from performance of substantial service by any person, or the occurrence of a condition related to a purpose of the transfer and the possibility of the forfeiture if substantial. The possibility of forfeiture is substantial if conditions are not satisfied. You're going to have a lawyer explain that one to you. But generally speaking, participants may have to forfeit their assets. And this is the scary part, and I'll cover this a little bit later too, but the assets invested in a 457 plan, either a B or an F, don't belong to the employee. Technically, legally, they belong to the employer, meaning in case of bankruptcy, those assets can be used to satisfy the creditors, and a participant could lose that money. So when you think of substantial risk of forfeiture, it's not just a terminology. It is legitimate, and you could lose your money. So source of plan documents. So IRS plan documents requirements. So you have to have a plan document, almost have to have a plan document. A 457B does have to have a document. It's generally provided by your record keeper. I have yet to find a qualified record keeper that doesn't have a 457B plan document. They're inexpensive, maybe 10, 12, 15 pages tops. They're pretty simple. But a 457F is the exact opposite. First off, I have yet to find a qualified vendor that has an F document. F documents are drafted by attorneys. They're custom documents. And at the beginning of this page, I said, kind of, you have to have a plan document. A 457F can have a plan document, or it can be part of an employment agreement if certain language is included. And I do have a couple clients where they don't have a plan document. It's part of their contract. If you don't have a plan document, look at the contract. If you do have a contract that references deferred compensation plans, make sure you have an attorney approve of that language. Otherwise, you've got a compliance issue.
Brian, we do have a question.
Yeah.
Do we have to offer it to all HCEs above a given salary, or can we choose just a few? An example, our 2 VPs, but not our president.
Yes, you can. And that's the nature of non-qualified plans. There's no discrimination testing. So you can offer it to a select group, a specific group, however you define it. The key is that they be some sort of highly compensated or management group, and that you keep it to, as you'll see down here in the second from bottom, less than 10% of full-time employees. So yes, if you want to offer it just to the VPs in a division in the Midwest, that's fine. You don't have to offer it to anybody above that pay grade. So eligibility, very timely question. Thank you for that. 457B plans are generally limited to a select group of management or highly compensated employees. Again, generally, it doesn't have to be all. While there's no formal definition of a select group of management or highly compensated employees, it generally means a small percentage of the employee population who, and this comes straight from the IRS, are key management employees, earn a salary substantially higher than that of other employees, or over the years, the courts and the Department of Labor have looked at one or more factors. So there's not a red line test here. It is a facts and circumstances test here. And you can see here, total employees versus number of employees covered by the plan. average salaries of that group, average salaries of the select group versus the average salary of management or other highly compensated, range of salaries of employees in the select group, to the extent in which the select group can negotiate salaries and compensation packages. So facts and circumstances, no hard and fast rules about who or what title or what compensation limit you have to include. You can define it, but if you define it, you have to administer it that way. No special privileges. But keep in mind, you can just amend the document prospectively to add a new type of employee in, again, so long as you keep it to a select group, 10% or less. A 457F, though, generally are further restricted to only the senior most or a targeted hire. So while the VPs in that question may get a B, the president may get an F. I'm going to talk more about why you would have an F a little bit later. But generally speaking, F is for a very specific target audience, and Bs are for highly compensated employees who you're either trying to retain by giving them money outside of your qualified retirement plan, or who are being restricted by the amount of employer contribution they can get because they make more than the IRS compensation limit of $290,000. Security of assets and funding of plans. So as I mentioned before, 457B and F plans are held as part of the general assets of the employer. They're a book entry. They are technically, legally, the employer's assets held for the benefit of a particular employee. These plans are subject to attachment by creditors of the employer in the event of bankruptcy. This includes employee salary deferral. So we have to be very careful that we are working with a reputable, stable, ongoing concern of an organization before we decide to put our money into a 457 plan. I have yet to see anyone lose a dime in one of these plans, but hey, we just had a pandemic come across our desk, right? We never really know what's going to happen. With that said, though, there is a security mechanism that you can put in place to provide a measure of protection, just a small measure, and it's called a rabbi trust. Now, the fact that it's a trust doesn't necessarily protect the participant, but what a rabbi trust does is it's established by an employer to provide a source of funds which may be used to satisfy the employer's obligation to the executives under a non-qualified benefit plan. What does that mean? It's a rabbi trust says you can only use the money in the trust to pay the benefit. You may not pay salary. You may not use it as an investment. You may not use it for any other corporate endeavor. It's restricted to the use of paying this benefit. But with that said, even the money in a rabbi trust is subject to the creditors. Funding sources, 457Bs are funded, but not necessarily self-directed. They can be, but they're not necessarily self-directed. 457Fs may or may not be funded, and they may be self-directed or not. An F plan, you could have a promise to pay somebody $100,000 3 years from today. There's no investment there, and you can fund it, put it in a savings account or a money market, or leave it as a debt of the organization. Or the converse is true. You can promise to pay somebody $20,000 into a funding vehicle that they can invest. It's up to you. They can be funded or not funded. And I have both as clients, funded and not funded.
Brian, we do have another question.
Yeah, please.
What if the employee was part of a select employment group, for example, upper management, then transitions to another group that is not offered the 457B, like a regular faculty plan? Can the employee continue to be eligible and contribute?
Okay, so we have to check our plan document to see how we're defining eligibility. I don't generally recommend that the plan document say Joe Schmo is in the plan. But if Joe Schmo is a vice president of finance and he's eligible, as long as he's in that position as VP of finance, he's eligible. But the moment that that person leaves that position and takes another position, maybe they were a vice president of finance and then they became a finance professor. Once their title changes, the compensation earned from that date forward is no longer eligible for the plan, but the compensation earned during the year while they were in that title is. By the way, same thing with qualified plans, because you'll see eligibility. Somebody changes hours worked or they change their category of employee. While they're eligible or while they're in the eligible class, they're eligible for the benefit. Once they're in the excluded class or no longer eligible class, then they're no longer eligible for that benefit. By the way, thank you for the questions. These presentations can get boring if it's just a monologue. So contribution limits, these are different. Keep in mind, these are different than your 401k or your 403b. So for the 457b, section 457e of the IRS code says 19,500 in 2020. This mirrors your 401k, your 402g limit. So your 401k and 403b salary deferral limits of 19.5, they mirror each other. So if you know one, you know the other. But for the 457f, there's no limit. You can put as much money as you want, generally. For the 457b, employer contributions can be fixed or discretionary. So I can give you 5%, or I can say I'll give you $5,000. And they can be determined separately for every covered employee. So the president can get X, the vice president can get 1/2 of X. For the 457F, it's employer-only contributions and can be fixed or discretionary. And I put only in the brackets there. I'm going to come back to that. You can make salary deferrals into an F, but it very rarely happens. Employer-only contributions can be fixed or discretionary and determined separately for each covered executive year to year. For the 457B, employee salary deferrals and the employer contributions are both eligible. You can make salary deferral or employer contributions, but, and this is one I see a lot, contribution limits apply to the salary deferral and employer contributions combined. So it's not 19,500 of salary deferral and another 20 grand of employer. No, every dollar that goes in, be it employer or employee, for a 457B counts towards the 19,500. That's a big problem that I see on a regular basis. There's no over 19,500. 19,500 is the limit for employer and employee. The 457 money does not count towards the maximum annual contribution allowed under 401k or 403b or 401a. Neither does the 457, but there are no aggregation limits here. These, the employee and the employer, aggregate to 19,500. 457B money does not count towards the maximum annual contribution limits under 401k and 403b, like I said here. 457B has no age 50 catch-up contributions, but there is a special 3-year catch-up contribution provision. What is that? I'll let you read it, but I'll explain it. If I'm eligible for a 457B, and say the first 2 years or 3 years, I did not defer at all. And for easy sake, we'll say it was $19,000. So for the first 2 years, I had eligibility for $19,000, but I didn't participate. And where's the word? Underutilized limitation is the amount I didn't benefit from. So I have 2 years of $19,000. So I have $38,000 of underutilized limitation. My catch-up contribution is equal to the lesser of twice the year's limit of 19.5 or my underutilized limit. So my underutilized limit in this story is 38,000 and twice the annual limit of 19.5 would be 39,000. So I could make up to $38,000 in contributions in a 457B as I approach normal retirement. Now, normal retirement, and this is a tricky one, the catch-up provision allows individuals within 3 years prior to the year in which they reach their normal retirement. So if the document says normal retirement is 65 years old, the year that I turn 64, 63, and 62, I can make these special catch-up contributions. And by the way, that number I used, 38,000, that's an aggregate. It's not for each year. But the year that I hit normal retirement age or the year after normal retirement age, I cannot use the special 3-year catch-up. So again, it's the 3 years prior to the year that the participant reaches normal retirement age as defined in the plan document. And for 457F plans, by all means, please ask a question about that one. That is a very difficult one. But for 457F plans, rules suggest that executives must perform services for at least 2 years in order to receive benefits under the 457F plan. A B, day one. As soon as I meet my eligibility, I can defer. For an F, I'm going to have to work for at least 2 years or have a contract for 2 years. Otherwise, I wouldn't be eligible. Vesting. So this is a trick, not by me, by the IRS. First off, the employee is always 100% vested in a 457B plan. In a 457B, the vesting allocates to limits. So I put in my own money and I put in $10,000. And let me do it differently. I don't put anything in, but the employer puts in $10,000. And then in year 2, I don't do anything and the employer puts in $10,000. And that employer contribution had a 2-year cliff vesting. So at the end of 2 years, I vest in that money, $20,000. The problem is $20,000 exceeds the $19,500. So employers that put vesting, and they very rarely do, on a 457 are going to face the limit problems. If I have multiple years of employer contributions with a vesting schedule, the amount that vests in that year cannot exceed $19,500. For that reason, we very rarely see vesting schedules on employer contributions into a 457B. Generally, it's 100% vested immediately. But it's the exact opposite for an F plan. In fact, the employee is 0% vested until they reach a predetermined vesting event. Predetermined, that's the important part. Each contribution that goes into an F plan, and they can be different year for year, has to have a distribution schedule attached. And that distribution schedule can be different for each year. So my 2021 contribution can have a 3-year vesting event at which it'll be taxable and distributable at the end of 3 years. But my 2022 contribution can have a 5-year vesting event, or it can say that my 2022 contribution will vest when I terminate employment. Each contribution with an F has to have its own distribution schedule. Each contribution can be different and unique from the prior year. Vesting is tied to duration of service. I'm going to work 3 years, and or the occurrence of an event until we sell that property, until I retire, until we finish this merger and acquisition, whatever the event is. But again, you're going to need an attorney to write this to make sure you keep up with the IRS rules. If an executive voluntarily terminates prior to the vesting date, the entire F contribution is forfeited. So remember how I said, yeah, you can put salary deferral into a 457F, but it generally doesn't happen. This is why. How angry would you be if you had funded it for 5 years and then you got into an argument with somebody and you decided to quit? You would have just walked away from 5 years of your own money. And we say vesting equals taxation. When you hit a vesting schedule or a vesting event, that's the year that money is taxable. So money coming out, distribution rules. So 457F. 457F is payable after the termination of employment. That's one of the real benefits of 457Bs. Like a 401k or 403B, as long as I'm employed, it stays deferred. It stays deferred. But a 457F is payable after a vesting event as per the plan document, and no early withdrawals of any kind are permitted. And remember what I said a moment ago. Every contribution has to have a predetermined distribution schedule attached to it. So not as flexible as a B. The 457B, no in-service withdrawals, but unforeseen emergencies. Basically, it's a hardship distribution. The rules are written very, very, very similarly. So no in-service withdrawals, but basically an RMD. I'm sorry, basically a hardship distribution. And 457Bs are subject to RMDs. But an F, no in-service withdrawals or unforeseen emergencies or RMDs. A 457B is not eligible for a rollover to an IRA or another employer's plan. And I get this question a lot. Hey, can I roll this into an IRA? Can I roll this into my new employer? No, you can't roll it into an IRA. However, moving money into a new employer, you can't do a rollover, but you can do a transfer if your plan allows a transfer out and the new employer allows transfers in. I didn't write the rules, folks. They don't want to call it a rollover. That's fine. They want to call it a transfer. Okay, fine. It's effectively a rollover, but the catch here is both plans have to allow for money out and money in. Oops, sorry. But a 457F is not eligible for a rollover or transfer. Once the money, once you have a distributable event, it's taxed. Under a 457B, there's no 59.5 distribution requirement or 10% early penalty. Same thing with an F. With a 457B, absent a written deferral election, I'll come back at that moment, the plan must pay the assets as per the default distribution, usually 90 days. Now, check your plan document because it might say 60, it might say 120, but what this means is if an employee terminates voluntarily or involuntarily on the 91st day or whatever number of days your plan document says, if they haven't put in writing their deferred distribution date, you have to force that money out. So if I quit on day 1, on day 91, you have to pay me my money. Better put, you have to force the money out of the plan. But if I quit on day 1 and on day 10, I say, give me the money January 1st of 2022 so I can defer my taxes. Now I'm allowed to defer that money beyond the 90-day window, and then you pay me on January 1 of 2022. But that written election has to be in place. Again, check your plan document on this rule 30 days prior to the 90-day window. Check your plan document because those are subject to your decisions.
Brian, we've gotten 3 new questions if you want me to go through them.
Sure. We're doing fine on time. Go ahead.
All right, sounds good. So related to, I think what this person is saying is number 6 under 457B.
I haven't gotten there yet.
Or 457, or no, sorry, 457F. For 457F distributions, what happens if a plan allows for redeferral or substantial risk of forfeiture without 125% material greater benefit?
Then you have a compliance failure. And whoever asked that question sounds like someone's been working with an F plan for a few years and knows a fair bit about them. This 125% material graded benefit is a newish rule. So it would be a compliance failure. So you would allow an impermissible distribution.
Great. Next question. Does the whole 457B become taxable at termination, or can it stay in the 457B subject to RMDs through retirement?
Yes, but no. No is the real answer. Technically, you could defer it out to normal retirement by putting into writing that you will defer distribution until you reach normal retirement. I'm sorry, until your RMD event. So if that's my written election and I did that prior to the 90-day window kicking in, then that's fine. But I don't think that was the question. I think the question was like a 401k or 403b. Can I just leave it there until I'm forced to take it out by the IRS for RMD rules? That answer is no, but you can put a written election in to defer it. Again, if you don't put a written election in for a 457B, then on the 91st day or 121st or 61st, whatever your plan document says, you have to pay it out. Money may not be left in a B plan indefinitely.
All right,
And the third
question related to 457F. If an employee is vested and is taxed but still employed, are the funds still subject to creditors?
Yes. As long as the money's in an F plan, they are subject to creditors. And if an employee is taxed, there's 2 things you have going on there. One, does your plan document allow for a distribution for tax purposes? And you can do that. Thank you to Mark Fossey at Trucker House for teaching me that one. But yes, you can have a special provision in a 457F that allow people to leave their money in, but it is still taxable on that vesting date. So if I take if I have a $500,000 vesting event, I can leave it in the plan, but I have to pay taxes on the $500,000. Some plan documents will have a special distribution provision to allow you to take out enough money to pay the taxes on that distribution. And was that it?
We actually did have one more if you want to keep going. The question is, not being easily portable is one of the main objections for HCEs not participating in 457Bs. Is there a better way to promote? There seems to be more downside than upside.
You're getting beyond my skill set, but you can do some split dollar insurance related benefits that aren't subject to these rules, but because they're insurance, they're very, very expensive. But my immediate interpretation of that question is that the participant doesn't really understand the benefit. Because you get extra money in a tax deferred vehicle for a substantial number of years if you work with the employer. If not, then you pay taxes at a later date of money that you would have already paid taxes on at an earlier date. So the portability question, the portability point is valid. But if they're a long-term employee, they're going to have a substantial taxes deferred on this money. I'm going to jump back into the slides. Lindsay, please let me know if there's other questions. So sorry, I lost my track here. I was heading to the F. Okay, so as I've said a few times, and hopefully everyone in the audience here has picked up on it, for 457F, distributions are prescribed by the plan document and has limited options to alter the structure and or timing of the payout, meaning when I get the money and how I get the money. And by what I mean by how is, do I get it in a lump sum, or am I paid out in installments or an annuity or whatever it might be? But as the participant had asked, you may make in an F plan, you may make a one-time additional election to defer, but not accelerate. So I can push back the distribution timing, but I cannot advance my access to that money. If the election is made 90 days before the distribution event. But as you can see, points A and points B, and I'll start with point B. The deferral would have to be for at least 2 more years. And point A, material greater benefit, this is a newish rule. The benefit paid more than 2 years from now would have to be at least 125% of the benefit deferred. So if you have an F that's a defined benefit plan, that probably makes sense. But if you have an F that's a defined contribution plan, in theory, that could require a substantial contribution from the employer. Because what if it doesn't go anywhere and it's 100% or 90% because they had losses, or 105%? The employer would have to make up the difference. So F plans allowing a participant to one-time additional deferral, not a popular concept. Does not have to be in your plan document. You don't have to allow this. Just because the law allows it doesn't mean you have elected to write this into your plan document. But with a B, the participant can also make a one-time additional election to defer but not accelerate the receipt of the benefits if the election is made before the distribution started under the initial deferral election. So I have that 90-day window, and I have put in writing that I want the money paid out in 2 years or 5 years or whatever the number is, so I can defer my taxes. If I get to that point 30 days before that distribution happens, I can make a one-time additional election and say, no, put it out 1 more year for me. That's what that means. But again, just because it's allowed by the law doesn't mean your plan document offers it. So check your plan document on deferral distributions. For a B plan, deferrals can be, distributions can be structured in many ways over many time horizons. I've seen clients that take out $4,500 a month. I've seen annuities issued. I've seen it quarterly contributions or distributions, annual contributions, and I've seen money deferred. I think probably the longest I've ever seen is probably 7 or 8 years, and that's a bit of a hope strategy, because remember, the money is subject to employers, and somebody that deferred their money prior to the COVID, if they said, "Oh, I'll put it out 10 years," they're probably sweating when COVID came, because something really bad could have happened and they could have lost all their money. Darn. Loans. So no loans are allowed in a 457B and no loans are allowed in a 458. 457, sorry. All right, we're coming up on the end here. Taxation. And I get this question a lot from clients, and partially because not all vendors can handle it. For the 457, taxes for federal and state when distributed. So when I get that vesting event and I take my money out, I pay taxes for federal and state. But contributions are subject to FICA and FUTA, Social Security and Medicare, as if the employee had received the money. The employer must withhold FICA and FUTA at the time of contribution. But with an F, the entire benefit is taxed when vesting occurs, regardless of distribution. And taxation occurs at, look at that. Taxation occurs at vesting regardless of whether the benefit is paid or not. For the F, all distributions are treated as wages for the federal tax purposes and reported on the W-2. Therefore, benefits are usually paid out at the time of vesting. But for an F, many vendors can and will issue a W-2 for the participant. So once the employee leaves, it's off the employer's mind. But not all vendors can. So some vendors, if they can't, they'll return the money to the employer, and the employer has to process it through payroll. And hopefully they remember that contributions were subject to FICA and FUTA. Otherwise, that participant will have overpaid on FICA and FUTA. So 457s are taxed for FICA and FUTA when money goes in, taxed at federal and state when the money comes out. A 457F is only taxed on the vesting event, regardless of when the money's put in and regardless of when the money comes out. How do we invest the money? So for funded plans, remember the Fs don't have to be funded. It can just be a liability carried on your books. For funded plans, any objective and market-driven investment that offers a reasonable rate of return, and here's the catch, is available to the public. So no private equity. Sorry. For funded plans, see vendor-specific limitations for stable values. So stable values are those money markets on steroids. Stable values may or may not be eligible depending on the investment product structure registration. They could be annuity. They could be a separately managed account. They could be a collective investment trust. Depends on how they're registered as to whether or not they'll be allowed in a 457B plan. But all vendors don't necessarily offer stable values, so you may not even have it available. And if they do offer stable values, they probably are only going to offer you theirs. That's how they're looking to make money. So practically speaking, you're looking at mutual funds or really an insurance contract or brokerage accounts. But you're looking at daily liquid funds that are going to be very similar to your 401k or 403b. For unfunded plans, well, it's not funded, so it doesn't matter. And the assets, if you should put assets away, are registered only to the employer and taxable to the employer. It is not a deferred asset. The participant gets the deferred taxes on that money because they haven't been paid it yet, but the employer would have to pay taxes on it. But most of these are going to be nonprofits, so you don't have those taxes. And participant investment horizons may preclude more volatile investments. If we think about it, the B can kind of stay until someone terminates employment, but the F will probably have something like a 3-year or a 5-year payout. Well, I don't think I want to invest in aggressive stocks if I might have to take the money out in 3 years, because couldn't you just see the market having a downturn and then me only getting 80% of what I deferred? Well, I should have just paid the taxes and taken it. So in summary, 457 plans can be a valuable reward or retention plan, but both the plan sponsor and the participants need to understand the rules and the investment horizons. Kind of like that one person before that said 457Bs may not be that valuable. Well, it's a tax deferral strategy. Lindsay, are there any existing questions, or does anybody else have questions?
The only question that's out right now I can answer, yes, we will have the recording and the slides available within a couple of days, and they'll be emailed to you directly.
Okay. I'll give everybody a minute just in case somebody wants to ask a question. And the timing is great. Somebody's landscaper just came. Lindsay, anything else?
Nope, nothing new right now.
All right. And folks, you can always email me or call me if you have any questions. And like Lindsay said, she will send out a recording. Thank you all for your time. And for those of you that ask questions, thank you very much. And if you want to follow up, please just reach out. I'm happy to discuss it with you. Thank you, everybody. Have a great day.